Investor outcomes are largely driven by fear and greed. Over the past year, we've seen divergent performances in markets, with some areas being characterized by high levels of greed and others by extreme levels of fear. Joining me today to discuss our take on global markets is Fund Manager Philipp Wörz. So, Philipp, I think if you can kick us off by sharing how PSG Asset Management has viewed recent developments in global markets.
Great to speak to you today, Audrey. So the market turmoil that we saw back in early August after the Bank of Japan hiked interest rates seems like a distant memory, given that euphoria has returned back to global markets after the US Fed cut rates and the Chinese government announced easing measures back in September. Now that currently means that most major global markets are trading at record high levels. And in particular, it's been the US that's been the standout performer, returning 36% for the 12 months to the end of September. Now, taking a step back and looking at a longer term perspective, there are several parts of the market where we are seeing significant levels of fear. And maybe to single a couple of those out, it's been the Chinese equity market this year that's been trading in a multi-year bear market until recent easing measures. But even after that, stocks are still trading well below where they were and at large discounts to global markets. And we've also been seeing significant pressure come into the Brazilian equity market. Investor positioning and sentiment, especially in the materials and energy sector, is very bearish, which naturally brings up really interesting opportunities to active investors like ourselves. Now, returning back to the current euphoria that's going on, we think investors are overly complacent with regards to what's been working more recently. And we would be cautioning investors that the risks in markets like the US are actually quite high, given valuations trading at historically high levels and the record high index concentration that we're seeing, with a few of the stock market darlings really driving those popular indices. And those tend to trade at high valuations on rising expectations. We also think that investors are complacent with regards to the US government's fiscal situation, where government deficits ultimately rival World War II levels.
So you mentioned complacency, and PSG Asset Management has for some time held the view that we might see higher and more volatile inflation rates. So given the Fed's recent rate cuts, what do you think the chances are that we could see higher than expected inflation, perhaps disrupting the market outcomes investors are expecting?
Sure, that's $1 million question. At PSG Asset Management, it isn't really our game to forecast where inflation rates ultimately settle. But importantly, to bottom-up investors like ourselves, it's interesting to see that after the inflationary scale that we saw in 2022, inflation rates have come back down towards central bank target levels. And importantly, expectations are also such that they're going to remain stable and low for the next 3 to 5 years. Now, critically to us, assets tend to be priced off these expectations, and the beneficiaries of low inflation rates we think are very expensive, whereas the beneficiaries of potentially higher inflation are generally undervalued. So, as you said in your question, we've had this view that we've entered a more volatile and a higher than historical period of inflation over the next several years, mainly given the historical underinvestment in the real economy, and factors such as tight labor markets, anti-immigration policies, the uncertain and volatile geopolitics, and importantly, these kind of high and rising debt levels in developed markets. Now, while we can't forecast and we can't predict whether history repeats, it's quite interesting to observe what happened back in the 1970s, where in about 1976, 1977, people also thought inflation was under control before coming back with a vengeance. But what's quite important to us, how we see things today, we think the market is ill-prepared should inflationary pressures resurface. And we did see a preview of what can happen to asset prices a couple of years ago.
So, Phil, we're in a challenging and uncertain global macro environment. How do you go about positioning portfolios given this level of uncertainty?
Yeah, it's sure. That's also a really good question. The reality is we have the reasonably strong view that to grow and protect capital in future is going to require different strategies to those that worked in the past. As you probably know, investors do tend to extrapolate recent outcomes, and the past decade has been dominated by the US market and growth shares. So we just step back and ask simple questions. What if that US dominance and growth dominance starts to peak? And what if emerging markets leave that lost decade that we've experienced behind? Additionally, we're seeing really interesting dynamics in the materials and energy space, where we ask the question that the underinvestment into supply, given a reasonably favorable demand outlook driven by things like the energy transition, could mean a very different decade ahead for these kind of companies. And we think to grow and protect capital in that environment, we are looking for opportunities in areas where the market is more fearful. And those tend to be in areas that are largely outside the US, in markets like the UK, Japan, and Europe, and several emerging markets, including South Africa, Brazil, and China.
So Phil, delving down into a little bit more detail, can you share with us exactly how those views translate in your portfolios at the moment?
Yeah, sure. So as viewers will probably be aware, we are an active manager, and the Peachtree Global Equity Fund has a high active share and looks different to popular benchmarks currently. Maybe to add some color to this, I'd like to kind of segment the portfolio into 4 key buckets. We've got about 27 to 30% of the fund in companies that we view to be secular winners. We think those are companies where the market is underappreciating the growth prospects. Here we've got companies the likes of ABI and Asahi in the brewing space. We've got Prudential, which is Southeast Asia's second largest life insurance company. We've been a buyer of a Chinese company called Antasports this year, which is China's largest homegrown sportswear company, which interestingly, during the bear market, we were able to buy it at low teens price to earnings ratios. And this is a company with a great track record and strong prospects for future growth ahead. Then we've got a bucket that we call real asset companies. Now that's a diversified portfolio of companies ranging from stocks in the integrated energy space, the likes of Shell. We've got we think a real gem in the portfolio with Petrobras based in Brazil. We've got companies in the natural gas space, in the uranium space, in the energy services, and also shipping space. Importantly, these companies are, firstly, we think they're cheap, but also returning lots of capital back to shareholders, and also have the added benefit of being beneficiaries of higher inflation should those pressures reemerge. And then we've got about 9% of the portfolio in precious metal companies. This exposure is a non-correlated exposure in the portfolio, also once again offering cheap inflation protection, but also protection against weakening public finances ultimately. And then last but not least, about 30% of the fund is sitting in global value opportunities, and those tend to be, as I mentioned earlier, in markets outside the US. And we've got a range of companies ranging from European defense, where we own Babcock International, that's critical to UK and European defense. We've got global reinsurance companies operating out of Lloyd's, discount retailers and global capital goods companies, and global holding companies trading at large discounts. And the amazing thing in markets like today is that despite the indices trading at high levels and higher valuation levels, if you're willing to look outside that, there's actually an abundance of opportunities available to active investors. And the way we look at the fund today, it's trading at a significant discount to the market, and we think offers strong prospects for capital growth going forward.
Phil, thank you so much for joining me today and sharing your thoughts on global fund positioning with us.
Thank you.